Sure. So we're going to get the Fed decision. Bryn, nice to have you in the house on Wednesday. Oracle and Broadcom are important, as we said. Tony Pasquarello, Goldman Sachs, keeps his responsibly bullish stance, says, looking forward, my baseline view is net positive. Why? The Fed's increasing liquidity into an upswing in growth. The flow of capital is supportive, and that's the core of my simple calculus. Other calculus today, Oppenheimer, 8,100 on the S&P. Next year, 7,500 for UBS. How are you feeling ahead of this pretty important week? Yeah. Important enough that it brought you to town.
It was. I liked how Professor Siegel said on Closing Bell on Friday, a hawkish cut. I think that makes sense, right? Because you're going to have Mirren, Waller. I think ultimately Jay Powell is going to cut 25 basis points. But I think this really sets us up for 2026 that we have QT ending, so we have more of an accommodative Fed. We're getting rate cuts, helps the short end. We also have the fiscal impulse from the OBBB, which goes into effect. And I think that tax refunds are going to be above average. And so I think and earnings, don't forget earnings, are all in place. So I think we're setting up for a good backdrop, albeit I think it's probably going to be pretty choppy.
Joe, rates are already moving up, right? The long end's been moving up. You got the 10-year at 417. What does that mean for the market?
It means that as the calendar turns into 2026, it's something that you're definitely watching for. Right now, 84% of global central banks, their last policy action was a rate cut. You do not want to see that figure fall below 50%. That's when historically markets get into trouble. We know what's going on in Japan. We heard from the ECB over the weekend that they are potentially ending their rate cutting cycle.
Is that the biggest wild card right now?
I think it is.
I think it is. In the long end?
I do, and I think what's going to be important from the Fed meeting today is, and I understand Kevin Hassett doesn't want to look into the next 6 months to see where policy might be, but I think the trading community wants an understanding when the rate cutting cycle ultimately is going to end. Is it going to be 2 cuts in 26?
Yeah.
Is it going to be no cuts in 26? Or are we going to be cutting 1 year from today, which means we have a bigger problem in the market?
Within the last hour, FedWatch has come out and said, quote, given the economy is showing signs of strengthening, yields may retest the 425 area in the near term. Is that going to be a problem, Shan, for stocks?
I think 425 will be digestible for stocks. I think that if you look at what they've been able to do over the course of the last couple of years in a higher rate environment, particularly, Scott, if the yield curve is steepening based on expectations for stronger growth. We also, to Bryn's point, if we're going into 2026, we have that stronger growth tailwind. We have a lower rate tailwind because I actually think they will cut a couple of times in 26 as well, because the employment picture is not going to strengthen meaningfully over the next couple of months. There's no indication of an improvement there. Granted, not an increased deterioration, but no real improvement likely to come over the next few months. And so I think what stocks are really going to be watching is, does this upset, does higher rates potentially upset some of the momentum of the tech trade, for instance? And will the rest of this broadening out trade continue into 2026 and provide enough of a support for the market to overcome some near-term volatility?
I mean, we have people talking about the fear of missing out, Amy, between now and the end of the year. You have people who are chasing performance between now and the end of the year. Is a backup in rates further the only thing standing in the way of this market having a nice little move between now and the end of the year?
Yeah, well, typically in December, people don't want to sell, especially after a good year, because you just have so many gains that why not push it into next year? So I do think we're okay for the next few weeks. But I do think there's a concern if the Fed can't get the long end down, if that's what the market concludes, then I do think you have a problem, because the stimulus from Fed cutting is really in the housing sector. It's in those capital intensive sectors. And that means you're not going to get mortgage rates down. And that is a problem in my mind.
There's the idea of a hawkish cut sending rates higher. And it's pretty obvious. But the counterintuitive play is one that Michael Hartnett at Bank of America was talking about last week, that a dovish cut could also do the same thing, because it could stoke inflation fears. It is interesting today that you do have the New York Fed 1, 3, and 5-year inflation expectations were unchanged. You're going to get a forecast too, which is even more important because, as Steve Liesman is going to tell us right now, you're going to get a forecast, Steve, based on data that the Fed hasn't gotten because of the government shutdown, to which, for the first time, I think I heard you suggest maybe we shouldn't even have a meeting. You did that on social media.
Yeah, I've said that a couple weeks ago, Scott, when I realized that the data was going to be as late as it's going to be. There's my blue sky tweet, I guess you call it. And there's two reasons, Scott. One is that the Fed is making the current decision with the delayed, without the data. But it's also putting those forecasts together. And maybe what people don't understand is that when you put a forecast together, a good chunk of what you think is going to happen is based upon what you think happened or what the prior data say. So I don't understand these models that are going to spit out the Fed's forecast for unemployment, CPI, and growth. It strikes me they're going to be kind of worthless, and the market's going to have to really take a key part of the Fed's forward guidance, which does come in these forecasts, with a huge grain of salt. And that's going to stick around, by the way, Scott, until March. It's not until March they come out with another set of data. So all of this strikes me that if the Fed is data dependent, I don't see what it would have hurt them to wait a week. If you look at what comes out next week, the jobs numbers come out and inflation data come out. And it's not just 1 month's worth of data. It's 2 months worth of data, because you get October and November payrolls, no October unemployment. You'll get retail sales, and you'll get a November CPI. So I think I'm just a lone voice on this issue. I don't hear a lot of people calling for this, but I don't know. Maybe a couple late change fees for their airline tickets it would have cost them, but I don't think it would have cost them much to wait.
It is funny, and I couldn't help but chuckle for a moment when you talked about the idea of the outlook being, quote, worthless, and that we should all take it with a grain of salt. As some suggest, every time you should take it with a grain of salt, and every time it's a little bit worthless, because they have proven to be a little bit of that as the Fed tries to guess where things are going. But if I told you that according to the New York Fed inflation expectations 1, 3, and 5, that they're unchanged and that the labor market outlook has improved, I would say, okay, that's a pretty comfortable environment to cut.
Well, I'd say two things to that. One is that inflation expectations are unchanged at a higher level, right? Those 3% numbers are not what the Fed is looking for. They're a bit elevated from where they were before the pandemic. And I do not think it costs the Fed a whole lot to cut here. If it ends up being wrong, I think it doesn't want to be wrong in not having cut, right? It doesn't want this data, employment data, to come out super weak and say, well, we should have cut the prior week if it waited. I do think, though, there's some talk out there that the economy is accelerating already, and you have not brought inflation down. There's a bunch of people on the committee that think, hey, this is an issue, that for 4 years going on 5 years, we're going to be above 2%. We're going to be closer to 3%. And that's something the Fed ought to be concerned about. We'll have more of this tomorrow, Scott, in the Fed survey, where I will tell you ahead of time here that the concern about inflation is now the #1 risk to the expansion.
From 399 on the day that the Hassett name was first put out there in that report to 418 today. Why do you think rates have backed up?
Well, Scott, there's always a lot of things going on in the bond market. There's inflation expectations, there's term premium, there's stuff happening overseas. But I will tell you that among the commentary that I've read, there are those who are saying it is the Hassett pick that is the matter of concern here, that you're going to have a Fed chair that is going to be more beholden to the president's wishes for lower rates than perhaps the dynamic of inflation and unemployment. So that is a concern out there for the market. It's a concern that the market ought to, in a normal course of business, exact some compensation for. If indeed it's going to be a chair who is not going to be as concerned about inflation, every chair comes along, every new chair comes along and has to prove his or her bona fides to the market, Scott, about inflation, that they're willing to risk recession in order to stop inflation. And I think that this, if it's going to be Hassett, this Fed chair would come in having more to prove than others have in the past.
It's an interesting thought. Steve, thanks. Steve Liesman, our senior economics correspondent.